favor of this company going forward?
Surabhi, thanks very much for that. So keep an eye on that name. Well, the pre-open session is on your screen, and we are 5 minutes into it. Prices should settle down in a couple of minutes more, and then we head to market opening at 9:15. Crude prices have been pretty volatile. Last night they went up a little bit, but they slipped $10. I mean 10% to this week itself. What does this mean for the oil and gas space here? Dayanand Mittal is oil and gas, he looks at the oil and gas space, he looks at the telecom space at JM Financial Institutional Securities. Dayanand, great to have you with us here. Good morning, Prashant this side. So let's just start with ONGC, right? ONGC, I think the stock is still pricing some $40, $50 in terms of Brent crude prices, whereas prices are closer to 80. With maybe upside risk, notwithstanding what we are seeing right now, which is, sharp slowdown in China, the reopening not coming through in terms of impact on asset prices, commodity prices basically, but at some point it will. Your sense on ONGC from here?
Yeah, so we have a buy rating on ONGC with a target price of 205, and our primary thesis is, one, it's a good dividend play story. About 8 to 10% dividend is what we expect this year on EPS of anywhere between 30 to 36 rupees, depending on their final net realization. So that's one. And second, as you rightly mentioned, the stock is discounting probably net crude realization of around $50, while various changes to the windfall tax regime suggest government is fine ONGC making a net crude realization of $75. So there's enough headroom. $1 higher net crude realization implies about 2% impact on their earnings. So I think there's a decent 25 to 30% upside in this name. The key concern in this stock is, given OMCs are still burdened with huge auto fuel under recoveries, probably in the range of 70 to 80,000 crore for FY23 so far, there's probably a 10% probability event that government might ask ONGC at the end of the year to bear some more subsidy burden. Though we don't build that in an estimate, but that's what market is worried about. So yeah, but still, I think given where valuations are, I think that it's a reasonably decent risk-reward play.
The same logic would apply to Oil India as well? You would have a buy on that, Dayanand?
Yeah, we have a buy on that as well with a target price of around 250. Similar rationale, but we prefer ONGC. It's more diversified, more liquid name.
And you're not touching any of the oil marketing companies?
So OMCs, we would be more cautious, primarily because of a view that we don't think crude is going to settle at below $75 for long. I think there's upside risk to crude, primarily because of two factors. One, the supply side concern still continues. Russia has said that probably they'll not supply oil to countries who comply with the G7 pushed oil price cap from Feb onwards. Good for India is that India and China are not complying with oil price cap. So no issues with the Russian supply to India and China. But to other countries, if there's a cut, then that could add to the supply side concerns. Further, EU's ban on Russian oil products also comes into effect from 5th of Feb. So I think there's enough supply side concern that can support crude price. But more importantly, the second factor why we think crude can stay supported at a higher level for long is the OPEC's resolve to support crude price in the absence of US shale not responding to high oil price. So US crude production is in the range of 13 million barrels per day, right now around 12 million barrels per day, which is still below the 13 million barrels per day that they used to produce pre-COVID. So despite high crude price, E&P companies are not investing in US shale, having learned from their past mistakes, because it's a long lead cycle investment. So by the time they come to generate profitability, probably oil price might have collapsed. So that is giving OPEC a very strong pricing power, and they have communicated in very clear terms that they'll come and support crude in the event of any macro weakness related uncertainty which comes into. So given that backdrop that we don't think crude can stay below 75 for long, I think OMCs, though valuations are reasonable, but we'll still stay away from OMCs for the moment.
All right, Dayanand, requesting you to just hang on for a minute. It's 9:10, so we'll just get Mitesh's call. Mitesh, what's your call at 9:10 today?
I'll go with a buy on Ashok Leyland. Keep a stop below 145 half year and look for a first target of around 155 to about 156.
Okay, just for your information, Bajaj Finance is at least starting in the green. So some bit of short covering perhaps is in order. And the indexes itself flat to mildly in the green. The global cues are still looking green from Asia. Dayanand, okay, no for oil marketing companies. I was more interested in city gas. The city gas companies, we've seen, along with crude, a fairly sharp fall in natural gas prices as well. Sooner or later, you think these guys are going to benefit, the city gas guys?
Yes, I think city gas companies are more structural stories, given penetration of CGD companies in India are quite low at sub 10%. They have a reasonably decent pricing power, though it has got eroded over the last year or so because of high global gas prices. But we all know this high global gas prices are not sustainable because these are 1.5 times equivalent oil prices, and hence there would be demand destruction. So recently we saw of late global gas prices have kind of corrected sharply, but still at a relatively high level, and probably may stay at a relatively high level for another 3 to 6 months, given supply side concerns still continue. But yeah, over a 1 to 2 year view, we think global gas prices will moderate sharply, and which would give back the pricing power that CGD companies used to enjoy. And also it's a clean fuel, and we all, particularly in India, we are focusing on reducing our carbon emissions. So this is one of the ways by which government will achieve that. So I think the policy support for CGD companies will continue to be favorable, though not as favorable as it used to be 5 years back. But I think it will be relatively benign regime for them. So we continue to like CGD companies. IGL and Gujarat Gas are preferred among the three CGD companies that we cover.
All right, Dayanand, thanks very much. Good speaking with you. Thank you very much for your time here on CNBC-TV18. Now, the standout brokerage reports. Nimish goes through a long list of what is being published each morning, and he comes up with what he thinks should stand out. Nimish, good morning.
Morning, Prashant.